Afternoon. So today, after economy and industry analysis, we will focus into company analysis. After all, at the end of the day, we are going to buy stocks of companies. So it is very important that after getting a good idea about the economy, how it is doing, I'm referring present scenario, so the economy is doing well. You have to focus on the industries which in when the economy is going up, industries also will go up, and for that we have discussed some types of industries like growth industries, cyclical industries, etc., etc., to have an understanding which are the industries we should focus on. Now, once you focus on the type of industries, you can focus on. Now you can look at the company. We have also studied earlier the Otis five-factor model, in which we have seen within the industry there is a different thing. An industry, as an industry, it faces pressure from the supplier, pressure from the buyer, fear of some substitute coming in, etc. But within the industry, there is a dynamics working, and somebody is a big player, somebody is a small player, somebody is also a player, and some fight is going on between big players and not so big players. Like if you look at steel sector, there are many steel companies, but like Tata Steel, JSW Steel, Jindal Steel, and then SAIL, of course, our public sector undertaking. And there are so many small steel plants which are not blast furnace steel plant, other type of steel plant. So you have to narrow down which company you are going to look for if you think you are going to buy steel company. Similarly, in case you are not going to buy that, you have to think of it. Just a minute. Uh, 1 minute. Okay. So now let's move to the next phase, next page. That is your company analysis. Once one completes, as I told you, economic and industry analysis, the key question comes is which companies share to buy. Generally, if the economy and certain industries are doing well, the first effect will be few companies' revenue will be growing. If the economy starts growing, people are buying a lot of things, then you will find that maybe Hindustan Lever's sales will increasing, ITC sales will increasing. If the government is spending a lot of money into infrastructure, then steel, cement price, revenue. What we want to say here is the revenue. Revenue will be growing, sales will be growing, companies' revenue will be growing. So now companies' revenue will be growing, and we will be focusing on that company's revenue. And it is important to choose from them considering the present price, stability of growth, and how return the stock can give over a period of time. So once you see that this out of 4 or 5 companies, couple of companies sales is really growing. If sales grows, then automatically some expenses, of course, will grow, but the profit will also grow. The probability is profit will grow if the management is good and not diverting money. It will show in the profit directly. And question is now that how stable is the growth will be, whether the company able to maintain that growth or not. And if I hold it for a particular time frame, which is in your mind, if I for a long time or something, whether what type of return I can expect. So I can give us a simple thing, which is not much related to the economy or industries definitely. Look at sari. It's a very common wear for Indian women, and it is economy is doing well or not. That may depend on whether I will wear an expensive sari or not. But the economy, but the industry will be always doing well. Now, within that, there are a lot of companies which are selling sarees. But if we recently, last 2 years, we look at it, there is a new brand has come in the market, Taniera, which is in the upper grade of the market, upper middle class in segment, में 6,000 plus sarees, and it's from the house of Tatas. So now, if you are a person from Patna and you have gone to Chennai, you do not know much shops, and you want to come back with something, so you can go to a Tata shop because Tata has over the years have some reliability, and you buy something. So that way, if I look at it, then Tata, that company's name is Titan Industries Limited. That company's shares price should be doing well because they have Tanish, which is gold, it may go down or go up for some reason or other, but overall it should be doing well. And now they have the sari also. They have fast track. They have Titan eyes. So if you look at it, you look at it. You have they have first is watches. You cannot in every marriage, at least some or other, a pair of watches given nowadays, wearing watches, but they are moving into the high grade watches. Then they have Tanishq. Tanishq is your Tanishq. It is your gold. They also have Karatlan, which is diamond. Now they are having this Taniera, which is saris. Now, whichever the situation is, if you look at it, whichever the situation is, generally these sales may come down a little, but if the economy is doing well, this will go up again. And if the marriage ceremony is there, then this Tanish will do very well, as well as Taniala will do very well. And also there is a habit in the gift may one pair of watch, ek to ladka ka, ek to ladki ka, you give. So it has to do well even if the economy is not doing well. It may do less well, but when the economy will do well, it will do better. So that is why it is important to know and how stable it will be, quite stable in the long run. So this is where we should go for. This is one example I gave you, just like that. We have to go for analyzing the companies. There are many other things to be analyzed. Now this, like this, I analyzed. There is financial performance, there is competitive positioning, there is management team, there is industry trend, there is growth potential, there is corporate governance. Now, if I follow Titan only, let's. I'll go to the Titan later on. Let me see financial performance. Financial performance may we will see naturally the profitability, but before profitability, we have to see the growth. If the revenue is not growing, then it's difficult to grow profit growing because you have to increase the market price. After some time, you cannot increase market price, so your revenue have to grow. So growth is the sales growth. Sales growth has to be there. Then profitability has to be there. Then the question is that you should generate enough cash flow. Otherwise, there is some problem. The cash is getting with the Sunday debtors and the creditors. Someday they will not be able to pay. You will be in trouble. Then there is a question of other things like debt equity ratio. Common parlor people say 2:1, or I would say it can be depend on the industry you are, but lesser is better. So 1.2:1. For electricity and other companies, it's 3:1. Like this date, because why it is 3:1? Because if you once construct electricity, if you once construct that electricity plant, it will produce electricity and people will consume electricity. So your revenue flow will be not go up, but it will be steady. So you can service the loan and other thing, higher loan also over a longer period of time. And these are generally these are for 30 years and other things. One power plant, coal fire power plant is like 30 years or something like that. So these are the thing ratio. Then there is a current ratio, that is current asset and current liability. So people again say 2:1 is a good ratio, but again 1.5 to 2:1 will be a better ratio. And nowadays some of the very smart companies, they maintain very less current assets because like Maruti, all the subsidiary manufacturers, I'm not subsidiary, all the supplier manufacturers, ancillaries are nearby. So they are supplying the material, and Maruti is manufacturing, and Maruti is completing the car, and they're sending it to the dealers and billing them. And after they get the bill paid, or after billing them, they are making the payment to them. So they reduce the current asset payable position. You get my point? So current asset quickly goes to the product and go out as a manufactured products. There is a concept of zero-based inventory or just-in-time inventory, just-in-time inventory, just-in-time inventory. So I don't have current asset to maintain. It comes in, manufacturing process goes on, the car goes out. So my current asset is very low. In that case, क्या होगा? Your money will not be blocked in current asset, it will be in productive asset. Now let's see management team. This includes evaluating the leadership team's track record, experience, ability to execute company strategy. Here I come back to Titan, as I was telling you, Titan. So in Titan, we have seen it is managed by Tatas, and they can execute big project. They can stick to a good time, bad time, and they have a track record. They have proven with the Titan. They have track record to maintain good retail network and other thing. And now that is why they are coming with the West Side and some other Chroma, etc., in retail business. Industry trends. Now, this is very important. Now, industry trend in understand the trend in industry in which company operates. Suppose I am looking at cement. Suppose I am looking at cement, and suddenly I am looking at cement, and suddenly economy is not doing well. Economy is not doing well. Government is not putting money into the infrastructure, and economy has gone down, and people do not. Interest rate is high. Interest rate is high. Interest rate is high. Sorry. Interest rate is high. So economy is going down. Interest rate is high. At this moment, you may not think of buying a house or building a house. So cement demand will come down. So you will not at that moment enter into a cement stock. Like those who are short-term player, because of the rainy season, बारिश के टाइम में, many short-time player they get out of cement stock and they get in again after Puja or Diwali when the construction will pick up. The cement will sell, the profit will come, etc., etc. So if you're a short-term trader, you have to keep track of industry trend like that. It is an industry like this, or I can take advantage of this growth or not, or I can take advantage of the full growth from year to year or not, etc. Finally, there is a growth potential that involve assessing companies' potential for growth, whether they have the money to grow or not. I know a company nearby locality. They are a jeweler. Now they're a good jeweler. They have 4 shops, but I know they don't have the capacity to grow like Titan or Kalyan Jewelers now, or Aditya Birla has come with. I don't remember the name. They have come out with a jewelry, and they have money to put up showrooms, or they can bargain with some people. You give me on a sharing basis, in the sense, partly the rent will be fixed, and partly rent will vary upon the sales. So this type of deal they can enter into with a landlord, but it will be difficult for somebody else, you, me, or a small manufacturer of jeweler to get into that type of. So his growth potential, though the potential of growth is there, but his bandwidth is not there to capture the growth. Okay. Now the question can be how it is. There is a lot of other answers are there. The corporate governance. This includes evaluating the company's board of directors, executive compensation, shareholder rights, etc. Now, generally, if a company's governance is good, then the internal company में जो माहौल रहता है, this is good. The people inside the company, the management, those who are executing the thing, they will be feeling good. The supervisor, the junior staff, because they are getting the reasonable remuneration, compensation is good. They are taking care when the price is going up. They are transparent when they are having growth. They are giving bonus, or they are sharing their ESOP also time to time. That means they are sharing their rights also. So you also will feel like giving back to the company. So this is what is corporate governance. So these are the some broad think about a company. Beside financials, you have to look into it. Okay, because finance may be good, but the company may not share the benefit. Okay, something like that may happen. Or management team is not good, so you may think, "Oh, आज का चलता है, कल क्या हो जाएगा पता नहीं." Many of the small cap and mid cap may we have that fear. Okay, so next we move to the next one. Now, valuation of a stock. This is a very important part. In your syllabus, there are some valuation. First, I will go through that. Now, there is something called book value. The book value is, as I have mentioned here, book value is your net asset value minus liability. So, if my net asset value is 1 lakh and liability is only 30,000, then my net asset value is 70,000 or net assets, and this is nothing but my net worth, or this is the book value of the company, right? Now, generally, most of these things are talked in per terms of shareholders. So if this company has 100 shareholders, if this company has 100 shareholders, that means this will be having 700 book value. If this company has 1,000 shareholders, then the book value will be 70 per share. Okay. So if you are starting a small, that is why if you're starting a small business, your shareholder will be limited. But if you have a big business like Reliance or Tata's, your shareholder will be, number of shareholders will be much more. In fact, Reliance has more than 30 lakh shareholders, whereas a small company will not have even 7 lakh shareholders. That is the important part. Second is that, so this is book value. This is the basic value of the company. All the assets minus liabilities, this is the value. Now, next I go to the liquidation value. Now, this is the interesting part. Now, this is a very negative way of looking at it. Suppose the company goes shut. Then if I sell all the assets, if I sell all the assets, this represents the amount of money that could be realized by breaking the firm, selling its assets, repaying debt, and then distributing remainder to the shareholder. So suppose, as I told you, I had a plant and machinery of 70,000. I have a plant and machinery of 70,000. Now on a distress sale, I may not get 35,000. I have a liability of 30,000. So 5,000 is my residual value or liquidation value for my shareholders. So this is one way of looking at it. But this is also another way of valuing a company. Another very different type of valuation method is replacement cost. I would like to tell you that when Mr. Harshad Mehta was there, he was trading in the market. He was very insisting on this replacement cost method concept. He was using a lot, like Tata Steel. Tata Steel, Jamshedpur. Now, this was set up 100 years back. So, if you go to replace this, it will cost more than the Kalinganagar mein they have set up a research plant. So, it may cost 3 lakh crores or 4 lakh crores. But at that time, only 10,000, 15,000 crores may they have That means actually this value of this Tata Steel Jamshedpur will be around 2 lakh crores or 3 lakh crores, less some depreciation, etc. Because that is the price you have to pay if you want to set up a similar plant. If if the Tata Steel for some reason or other, God forbid, no, something happens, something wrong, and you have to rebuild the plant. Now you have to pay almost 3 lakh crores or 6 lakh crores. But whereas when it was set up Tata Steel, and time to time it has grown, so its value is something like 50,000 crores. So many people try to look like that, and then they find this asset is undervalued, so buy these assets. So these are the various say book value. Book value is a method, and then residual value was a method, and then is your replacement value. Replacement value is a method I discussed. These are all book value where we focus only on the assets of the company and their liquidation market. Now, what they don't capture is that these assets will generate money, cash, for a long period of time. And that is why the market value, a market looks at it in this. So market will be valuing this cash flow. Now, suppose I am giving loan to you 1 lakh rupees at the rate of 10%, 1 lakh rupees at the rate of 10%. I will be looking at every year, every year I will be getting 10,000 for say 5 years, and after that I will get 1 lakh back. So this asset of 1 lakh is no more now an asset of 1 lakh book value. It is generating 10,000 per annum. At the end of the year, it will be also bringing back 1 lakh to a. Now, of course, there is a question of what will be the value of 1 lakh at that time. That is called discounting and etc. So, dynamic valuation process comes in where estimating present value, forecasting future earning, riskiness of that earning, whether you will default or not, then discounting. That is what is my expected return from this. All these create buying and selling pressure in the market. So any stock, any stock, suppose it is valued today, it is valued at 100 rupees. But there are 1 lakh shareholders, 1 crore plant machinery. They will generate dividend. They will generate dividend, and then it looks good. So more people will come to buy the share, and share price will go up. If something goes wrong, people will come to sell, share price will go down. So this dynamism will always change the current market price to a different price. So, in fact, price at a given moment is known to all of you. If you open the newspaper today, you know what is the price yesterday. But what is the value of the Ultratech? It is difficult. So you need to have a lot of various information, and accordingly, you will value in your way. And if you find that intrinsic value is more than the market value, then you will buy. Or if you feel no, it is already highly valued. Many times you will get the news that foreign buyers, FIIs, they think Indian market is highly valued, so they sell and go. Yes, obviously. If suppose there is a company, Nestle, if it is price earning ratio is P earning. So if your earning is 2, price is 30, that means for 2 rupees earning, you are ready to pay 30 rupees. Okay, so now if it becomes 90, that means for 2 rupees earning, you are ready to pay 90. Are you crazy? You can get 20 rupees if you put it in the bank, 10%, 20 or 30. If you put it in some bank, you may get more than 2. So The intrinsic value is very important, and you have to understand the intrinsic value of the company and the current market price.